Do you worry that the next market crash will drain your retirement savings? The truth is, crashes are going to happen, but they don't have to ruin your investments or your retirement. So in this video, I'm going to show you why you don't have to constantly worry about a market crash, why you don't need to try and time the market, and the one critical mistake that makes most retirees lose money when they don't have to. First, let me show you why a market crash is the number one thing retirees lose sleep over. This study from Schwab looked at two retirees. Both start with the same $1 million. Both withdraw the same amount each year. And both earn the same average returns over time. But here's the catch. One of them retires right as the market crashes, while the other doesn't see that crash until 10 years later. Take a look at the two lines. The purple line, Investor 1, runs straight into that early crash. Their balance drops sharply and never recovers. The orange line, Investor 2, avoids the crash until year 10. And because of that head start, their money lasts years longer, even though they faced the exact same drop. Same plan, same returns. The only difference was timing. But here's what makes it worse. We know crashes aren't just possible. They're inevitable. Take a look at this data on the S&P 500. Since 1980, the market has dropped 10% or more in nearly half the years. In the average downturn every year, nearly 14%. So it's not a question of if you'll face a downturn in retirement, it's a question of when and how many. With all of this, it's easy to feel like the odds are stacked against you. But take a look at what the long-term numbers actually show. Since 1928, the S&P 500 has had positive annual total returns about 74% of the time. So despite all the headlines, crashes, and pullbacks, the market still grows in 3 out of every 4 years historically, which is an incredible rate. But here's the problem. At the time of recording this video, it's September of 2025, and the S&P 500 recently hit another all-time high, and it's on track for its third straight year of double-digit gains. The year is certainly far from over, and with how good the market's been, you can't help but think, how long can this go on? Well, let's look at the data. Historically, when the S&P 500 has posted 3 straight years of double-digit gains, the fourth year hasn't been a sure thing. Between 1928 and 2021, DataTrek found it was up 5 times and down 4, basically a coin flip. And if you're at or approaching retirement after 3 great years, it's only natural to worry. Is the next year gonna wipe out my savings? It's like being on a hot streak at the casino. Do you walk away or bet on another win? As risky as this might feel, here's the good news. The numbers I'm about to show you tell a much more reassuring story, and they're the key to investing without fear. Let me show you why. Most people assume putting money to work when the market is hitting new peaks is just asking for trouble, that it's the worst possible time to invest. But check out this chart from JP Morgan. It tracks the S&P 500 from 1988 through 2023, comparing what happens if you invest on any random day versus jumping in at a fresh record. In the short term, 3 to 6 months, there's not much difference. Sometimes buying at a new milestone means a slight dip, but watch what happens as you zoom out. After 1 year, investing at a record high actually edges out investing on a random day. At 2 years, the gap grows. By 3 years, it's 48% versus 40%. And after 5 years, putting money in at market peaks has historically done better, nearly 80% success versus 74. That's the opposite of what most retirees expect. These new milestones aren't red flags. They're just markers on a much longer journey. Avoiding them out of fear can actually cost you growth. And this is exactly why, once you see the data, you can stop worrying about getting the timing perfect. But if buying at record highs isn't the problem, what about the crashes themselves? isn't sidestepping them the safe move? Let me show you what the history really shows. This Wells Fargo study looked at the S&P 500 over the past 30 years, from 1995 through the middle of 2025. It asked a simple question. What if you stayed fully invested versus what if you missed just a handful of the market's best days? Fully invested, your return was about 8.4% per year. Miss just the 10 best days, and it drops to 5.6%. Miss the 20 best days, and you're down to 3.7%. By the time you miss 50 of the best days, your return actually turns negative. And remember, this is over 3 decades. Just a few days made the difference between strong growth and flat or even losing money. The problem isn't just missing the bad days. The real danger is missing the good ones. So here's the question. Is there a way to dodge the drops without giving up the gains? Investors have been trying to solve that for decades, and the data gives us a surprising answer. Think about the weather. The biggest storms and the brightest bursts of sunshine don't happen months apart. They often come back to back. One day it's pouring, and the next day the sky clears and the sun shines brighter than before. Markets work the same way. JP Morgan looked at the last 20 years of the S&P 500. Here's what they found. 7 of the 10 best single days happened within just 2 weeks of the 10 worst days. If you tried to sidestep the pain, you almost certainly would have missed the recovery too. So if trying to dodge downturns is one of the costliest mistakes, how do you stay confident when the market feels scary? What makes it so tough is that in the moment, it feels like these drops could last forever. If you knew for sure recovery was right around the corner, you'd tune out the headlines for a while, and before long, your portfolio would be back to normal. So the real question is, how long do these market dips really last? One study of the Dow Jones, going all the way back to 1945, found that after a 5 to 10% drop, the average recovery took just 3 months. And for larger corrections of between 10 and 20%, it was about 8 months. In other words, most downturns don't drag on for years. Bounce backs usually come much faster than people expected. So if you're watching your portfolio fall, remember, recovery is usually just months away, not years. And if that's true, you'd think most investors would be fine. But what actually happens might surprise you. Delbar looked back 20 years to see how different markets performed compared to the average investor. Over that time, you can see all the way to the left that the S&P 500 delivered nearly 10% per year. Real estate and international stocks also put up strong gains. When you look at the chart, those bars climb high, proof that the growth was there for anyone who stayed invested. But now, look at the yellow bar. That's the average investor. Instead of enjoying the same growth, their returns were less than 1/3 of the S&P 500. And even worse, that number barely kept pace with inflation, meaning their money was swallowed up by the rising cost of groceries. That's the tragedy. Even with decades of evidence about the power of staying invested, most people still underperform, and not by a little, but by a lot. This is the critical mistake that costs retirees money when it doesn't have to. Letting fear control your decisions instead of following the data. And just like in almost any part of life, fear rarely leads to good decisions. Now that you've seen the data, you know what mistakes to avoid and why you can invest with confidence, not fear. But here's the thing. Once you stop worrying about losing your money in the market, the real question becomes, how do you actually enjoy it? If you want to learn how to use this confidence to spend more in retirement without guilt or fear, watch this next video. I'll show you how to tie your investing and spending together so you can make the most of your retirement.